If you've ever accidentally made purchases with a company card, reimbursed yourself for business purchases, or loaned your business money and are trying to figure out how to record this in QuickBooks Online, this video is for you. In our example, we'll use Jenny, who owns a partnership, to walk you through common scenarios that businesses encounter. Jenny accidentally used the business credit card when taking her family out for pizza. As much as she would love to include this as a business expense, the reality is that those weren't her clients. So rather than categorizing the dinner as a business expense, she categorizes it as partner distribution, so it never shows up on the profit and loss statement. The type of business determines what distributions and contributions are called. Distribution means taking money out of the business. For a sole proprietorship or single member LLC, it's called owner draw. For a partnership, it's called partner distribution. For a multi-member LLC, it's called member distribution. For a C corporation, it's called dividend. And for an S corporation, it's called distribution. Contribution means putting money into the business. For a sole proprietorship or single member LLC, it's called owner contribution. For a partnership, it's called partner contribution. For a multi-member LLC, it's called member contribution. And for a corporation, it's called shareholder contribution. Now let's record a partner distribution and see how it shows up on the balance sheet. To add the expense, we'll click on Create and then Expense. And they ate at Round Table Pizza. Jenny used the Chase Business credit card, and that was on the 7th of September. We're going to categorize this as a partner distribution, and the dollar amount was $65, and then we'll save and close. We'll click on Reports and then Standard Reports, and then we'll select Balance Sheet. We'll change the report period to this month, and if we scroll down, here we can see partner distributions for negative $65, so that means $65 was taken out of the business. Jenny's business needs a new printer. The current one is leaking ink all over the place, so Jenny uses her personal funds to buy it. Why do we want to record this expense when it didn't come from business funds? Well, it's still a legitimate business expense and it can lower the business's taxable income. There are two ways that we can record this purchase, as a journal entry or as an expense. We'll start by adding this as an expense. To record the expense, we'll click on Create and then Expense. The vendor was Office Depot. It doesn't matter which payment account we use because it's ultimately going to zero out. We have the payment date as September 8th, and the expense category was office supplies for $350, and the other account will be partner contributions, and this will be a negative number, negative $350. You'll notice that the amount is zero, so that means that no dollar amount will be applied to the payment account that we selected. It's important to add a receipt, especially because this was a payment made using a personal account, and then we'll save and close. The other way is to record this purchase using a journal entry. To add a journal entry, we'll click on Create and then Journal Entry, and this will be dated September 8th. Our first account will be office supplies, and we're going to debit the account by $350, which increases the expense account. We'll use the vendor, which is Office Depot, and our second account will be partner contributions. We're going to credit the equity account to increase it by $350, and then we'll save and close. When we take a look at our profit and loss statement for September, we can see the office supplies expense for $350. On our balance sheet for September, if we scroll down, we can see partner contributions for $350. Jenny wants to be reimbursed for purchasing the printer, so we'll record that as an expense. To reimburse Jenny, we're going to create an expense. We'll click on Create and then Expense. And the payee will be Jenny. We're using the US Bank checking account, and we're going to use the same category that we used for her initial contribution. So partner contributions, and this will be for $350, and then we'll save and close. Now we'll take a look at the balance sheet again, and we'll scroll down, and you'll notice that partner contribution zeroed out after we reimbursed Jenny. Jenny's business partner asked her to contribute money to the business. She agreed, but on one condition: she wants to be repaid. Can owners lend money to their own business? Well, it depends. For a sole proprietorship or single member LLC, the business and the individual are the same for tax purposes, so you can't lend money to yourself. For a multi-member LLC, partnership, or corporation, yes, it's possible. In this case, Jenny agreed to loan the business $5,000, so let's start by adding a liability account. We'll create the loan account by clicking on My Apps, and then Accounting and Chart of Accounts. Then we'll click on New Account, and the account name will be Loan from Jenny. The account type will be Other Current Liabilities because we'll be repaying her within the year, and detail type will be the same, Other Current Liabilities, and then we'll save. Now we'll deposit the funds into the checking account, so we'll click on Create and then Bank Deposit. And this is going into the US Bank checking account, and that was on September 15th. The funds were from Jenny, and we're recording the loan, so we're using the account that we just created, Loan from Jenny, and that was for $5,000, and then we'll save and close. To see the funds in the checking account, we'll click on View Register, and here we can see the $5,000 deposit, which was the loan from Jenny. On our balance sheet, if we scroll down, under Other Current Liabilities, we see the loan from Jenny for $5,000. They agreed to repay Jenny $500 on a monthly basis, so let's add the first loan repayment. The first payment will be made on October 1st, so we'll click on Create and then Expense. And we're going to pay Jenny from the US Bank checking account on October 1st. The category will be Loan from Jenny, and the repayment amount will be $500, and then we'll save and close. Now we're looking at the balance sheet in October, and if we scroll down, we can see that the loan from Jenny has reduced from $5,000 to $4,500 after the first payment was made. We hear so much talk about not commingling business and personal expenses. Why is this so important? Well, for a few reasons. First, you'd have to categorize your personal expenses each month, which could be a very time-consuming process. Second, there's a concept called piercing the corporate veil, which means that the court could ignore the protections that your business offers and go after your personal assets. And finally, do you really want your bookkeeper to know details about your personal life, like how many streaming services you use each month? The best practice is to have a business checking account and business credit cards that are for business purposes only. We've covered many scenarios that occur in the course of running a business, such as accidental purchases using the company card, using personal funds to buy items for the business, being reimbursed for those purchases, and loaning money to the business. I highly recommend you rewatching this video when you need some guidance. If you have any questions or comments, feel free to leave them below.